Hello, I'm Bill Dodwell. I'm the head of Deloitte UK's Tax Policy Group. And one of the areas that I've been working on extensively over the last year or two has been the change to international corporate taxation, which the G20 and the OECD are designing for us. 44 countries working together are resetting the whole of the international corporate tax framework, really to take much better account of how companies today do business, and also the significant changes such as technology and the growth of digital services that never existed a decade or so ago. So what's the background to the base erosion and profit shifting project? Well, I think there are three elements which lead to it. The first, of course, is a general lack of revenue generally following the financial crisis in 2008. Governments are looking for money. And we see this in two different ways. Revenue authorities globally, in some cases, are becoming more aggressive, are taking really quite interesting and novel positions in an attempt to extract money from companies doing business in their territory. Other governments are introducing their own unilateral tax measures. And the problem with that is they're not coordinated, and so they can easily lead to double taxation and the loss of economic growth that implies. And of course, underlying all of this is something which is probably called responsible tax. The acceptance that today's multinationals operate in a different form of society, and they need to be seen to make an adequate contribution to everywhere where they operate. Now, international corporate tax is only one of those areas. Investment and employment, indeed delivering services to customers, are really valuable contributions from multinationals. But corporate tax is a piece of that. And all of that is leading the G20 and the OECD governments, 44 in total, to work on the base erosion and profit shifting project, really to lead to better outcomes from all of that. No need for unilateral measures if they manage to agree enough things together. A much better understanding what tax audits should be getting out, so no concerns about that sort of thing. And at the end of it, also answering that difficult question about responsible tax by more realignment of profits to people-based activities. There are four big areas that the BEPS project aims to tackle. The first is called taxable presence, or permanent establishment in tax jargon. And that means, when does a multinational based in one country have a taxable presence? When do its activities in another country give rise to a taxable presence? And the aim here is to reduce the threshold at which a taxable presence is recorded. The old rules that we've had for many, many years were based on different assumptions and complete lack of technology as well. Today's modern communications and technology, today's regionalisation of business activities mean that we need to look at lowering those thresholds. The second big area is the question of profit attribution within the different companies within a multinational. It's called transfer pricing. It's a legal obligation that multinationals must set fair prices, arm's length prices as they're known, when goods and services are transferred between companies and between countries globally. But the assumptions and the economic analysis behind them is going to change, and the future is likely to associate much more profit with people-based activities. Legal agreements are vital. They underpin much of what we do. They underpin ownership rights of intellectual property, which of course is a critical part of today's global business. But the most important thing is to allocate profits to people. And that, I think, is where the base erosion and profit shifting project is headed. The third big area concerns interest deductions. Providing finance within a multinational is absolutely vital because all commercial operations need to be financed. But there's no doubt there's been some evidence that interest expense charged in one high tax country, paid to a low tax country, can lead to base erosion and perhaps profit shifting. And the OECD and G20 are working together at a plan to limit the total amount of interest deductions that a multinational might be able to generate. And the fourth area is something called treaty abuse. And that means using a double tax treaty between one country and another to pass low or zero tax profits through an intermediary country to another one that isn't a party to any of the tax treaties. So using a treaty in a way in which the countries that entered into it did not intend. And the plan here again is to limit the ability to pass through profits generally outside that treaty network. So how does the BEPS project apply to the Channel Islands? Because of course they are not part of the 44 countries negotiating this project. Well, the first thing to say is that participation in it, once the actions have been designed, is open to everyone. There will be a multilateral convention and over 80 countries already have signed up to participate and more are expected to do so. So jurisdictions such as Guernsey and Jersey can easily join in as observers and choose to bring some of the measures into their own domestic legislation. The second big question for the islands is, of course, to look at the question of double tax treaties. And of course, both jurisdictions have many tax information exchange agreements, but they have far fewer full double tax treaties. And the question will be whether it's possible to have new modern treaties, particularly with the UK, that take account of the modern environment. And the third big thing for businesses based here is to stay abreast of the changes. Be prepared for the new tax reporting that is going to arrive from 2016. Be happy with the outcomes, start to assess that sort of thing. And when the actions are decided on by the G20, which is expected to be in October 2015, start to move forward with action plans, because change is likely to happen even before countries have put this into their domestic law.